Before we begin, a mandatory disclaimer. The following analysis is an independent technical synthesis for educational purposes and does not constitute financial or trading advice. The closing hours of July 30th presented a price narrative, a steep morning capitulation followed immediately by a sharp intraday reversal back toward the highs. This 1-hour S&P 500 chart establishes the scale of that bounce, ending a multi-day decline. Analyzing the final hours, buying intensity is visible in these long lower wicks and a significant surge in green volume bars. The Nasdaq shows an identical structural signature, confirming that this aggressive bid was systemic across the major indices. The index drove vertically into the close, reclaiming the 28,106 level and erasing earlier losses. While this surface-level price action suggests a clear buy signal, index price alone is often a deceptive indicator. We have to identify exactly which assets were responsible for this move. The primary issue with cap-weighted indices is their tendency to mask the health of their underlying components. A rising index line does not necessarily reflect broad market strength. To differentiate between a healthy market-wide rally and a concentrated short squeeze, we use market breadth. This helps us see if the majority of stocks are participating, or if the index is being dragged upward by a small group of outliers. The Nasdaq is the most prominent example of this top-heavy structure, where a few mega-cap corporations hold a massive percentage of the total index weight. Mechanically, if these few heavy assets see intense buying, they can lift the entire index, even if the majority of individual stocks are actively declining. A V-shaped recovery lacking broad participation is structurally unstable. If those specific heavy assets lose momentum, the index lacks the breadth to maintain its levels. To determine the viability of this rally, we must step away from the price charts and examine the internal distribution of capital from yesterday's session. The index chart is a shadow of the real market. To see the true risk, we need to perform an autopsy on the sectoral distribution. This heat map of the July 30th session reveals the reality behind the bounce. Instead of broad buying, we see a divided market. The primary engines of the rally were isolated to semiconductors and software, with Microsoft up 15% and AMD up 13%. The divide is clear. Microsoft surged, while Meta saw a structural sell-off on the same trading day. This divergence between technology and defensive sectors suggests there is no unified appetite for risk in the broader market. The July 30th recovery is a fragile floor, supported almost entirely by Microsoft and AMD. This leaves the indices vulnerable to any systemic shock that targets these few remaining pillars. That vulnerability is now facing a systemic threat from the global macro environment. The catalyst for this threat is the Bank of Japan, which currently acts as the ultimate provider of global liquidity. This involves the yen carry trade. Speculators borrow Japanese capital at near-zero rates to fund massive positions in U.S. tech equities. The capital tied to this single central bank's policy is vast, forming a continuous flow into the tech stocks propping up the Nasdaq. This calendar shows why the threat is immediate. We have high-impact events scheduled for the yen, specifically the BOJ policy rate and the subsequent press conference. A hawkish surprise, specifically a rate hike, would act as a margin call on the concentrated U.S. tech positions that rely on cheap Japanese debt. If the BOJ hikes, the yen strengthens, making the carry trade unprofitable. This forces an immediate unwinding of positions, draining capital from assets like Microsoft and AMD. The Bank of Japan holds the catalyst that could instantly dissolve the concentrated tech momentum we saw at yesterday's close. We are now seeing a collision between localized corporate earnings momentum and a systemic liquidity threat. Looking at the Dow Jones, which lacks the heavy tech concentration of the Nasdaq, we see much choppier price action and a lack of clear momentum. Since the BOJ's decision cannot be predicted, a professional approach requires a strictly conditional if-then framework for the July 31st session. Scenario A is the bullish continuation. If the BOJ maintains its current policy, liquidity flows remain stable. In this scenario, the momentum in Microsoft and AMD will likely squeeze the indices higher toward previous consolidation zones. Scenario B is the macro shock. If the BOJ hikes or signals a tightening cycle, the liquidity support is removed. Because the broader market is already weak, the failure of these remaining tech pillars would likely cause a cascading sell-off across the indices. Entering this session with a definitive bias before the BOJ data is released is a failure of risk management. We must identify the critical failure threshold on the S&P 500 to manage bearish risk. This level near 7370 is the line in the sand. A break below this low invalidates the recovery. If price breaks this level on BOJ news, the lack of market breadth means there is very little structural support to catch the fall. The professional directive is to wait for the macro catalyst to clear before committing capital. Standard support levels are fragile during major central bank policy shifts. They often fail without warning. Yesterday's rally was an earnings-driven anomaly, not a signal for broad, unhedged market exposure. On days dominated by systemic risk, the goal is capital preservation. Wait for the market to reveal its actual direction.